there's so much more than just the 401k and Wall Street and the low cost index funds. There's a
Yeah.
whole giant world out there in private equity and real estate, and you really can diversify yourself, in my opinion, just being in a real estate sector.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is Ted Patel, and welcome back to this week's edition of Decoding Cashflow Podcast. I'm here with an amazing guest, Travis Watts. Travis is a full-time investor, passive income advocate, public speaker, and director of investor development at Ashcroft Capital. He dedicates his time to educate investors who are looking to be hands-off when it comes to real estate investing. Travis was awarded the Linda's Legacy Industry Impact Award in 2022. Travis, welcome to Decoding Cashflow. It's a pleasure to have you on the show.
It's great to be here, Ted. Thank you so much for the invite.
Awesome. I'm sure it's going to be an awesome show. If you can give our listeners a little bit background about yourself, how did you get started in the real estate, and what's your main focus as of now?
Yeah, happy to share that. And I think this will probably resonate with a lot of your audience. And I know you and I have similar backgrounds in certain respects as well.
Yeah.
But I was just a guy who was raised by two frugal parents. And so there was a lot of conversation early on in my life about saving money and frugality and using coupons and this kind of stuff. And so I got pretty good at that early on and through college and this kind of thing. But at some point, I really wanted to explore investing because that's one thing that my parents were not, is investors. And so I had read the books. A lot of us have read the Robert Kiyosaki books and whatnot, and kind of planted those seeds early on before I was really in a position to take action. And so I started working as a W-2 employee in the oil and gas industry, which entailed 14-hour work days and 98 hours a week. And I worked in Saudi Arabia, and it got really intense as far as my work schedule. So I began by doing fix and flips out in Colorado, and I did that for almost 7 years. And then I got into vacation rentals and some buy and holds. And ultimately what I discovered is it was really hard to scale that business model because every property I acquired was continuing to require more of my time over and over again. And meanwhile, I had no spare time to give. And so, it was a recipe for disaster. And I started exploring real estate syndications around 2015. And I started making a slow but steady pivot away from my active portfolio into the passive deals. And that really was a game changer in a couple different ways. One, it freed up my time so I could be a better person. I could have a personal life and relationships.
Yeah.
It led me to meet my wife and those kinds of things. But number two, it was just such a more scalable model. So much easier to have 50 syndication deals in my portfolio than 50 single family homes that I'm trying to flip and renovate and manage at any given time. So I did this, I've been doing this ever since, and I joined forces with Joe Fairless and Ashcroft Capital in 2019. They're a large national multifamily syndication group based out of New York City, doing a lot of Texas, Florida, Georgia, North Carolina deals. And so the reason I joined is because I wanted more education. I wanted education from the inside of the business, and I wanted to get out on stage and out on podcasts. I wanted to do webinars. I wanted to meet people. I wanted to do property tours. I just really wanted to immerse myself in this industry. And so that's what I do today. I'm a director of investor development at Ashcroft Capital. Done a handful of positions before that. And so just really the messaging is, I know with your audience, a lot of IT and engineer-minded folks and whatnot, is just to paint the picture that there's so much more than just the 401k and Wall Street and the low-cost index funds. There's a whole giant world out there in private equity and real estate. And you really can diversify yourself, in my opinion, just being in a real estate sector, between doing raw land and development and notes and value add multifamily and mobile home parks and self-storage and car washes. There's so many things you can choose from. There's so many angles to take it from. And so that's, my thing is passive income advocate at the end of the day, just trying to teach people passive income strategies in real estate.
Awesome. And the thing that you mentioned, right, there are many different avenues out there except for the Wall Street investing in stocks or bonds. And the main people do diversify within stocks and bonds, like within that segment.
Sure.
But the advantage of diversifying outside of the Wall Street is huge. Like, like diversifying into real estate, like stocks and bonds. In real estate, you get cash flow. In stocks and bonds, hardly you will get any cash flow on the regular basis. You can also take advantage of tax benefits in real estate, while in stocks and bonds, you have to pay the capital gain or if tax anyways once you sell. In real estate, you can roll up your investments, take the depreciation, do 1031 exchange if possible. So there are so many ways to save taxes. So maybe if in addition to what I said, is there anything that you want to mention about the advantage, disadvantage of real estates?
Yeah, Ted, you brought up some good points. So early on, this is at a point where I was doing flips for several years, and I decided that I wanted to, obviously I could see the benefit in what I was doing, and I could see the benefit of real estate, all the things you mentioned, tax advantages, cash flow, leverage, all this stuff. So I thought, okay, but I don't just want to be a one-trick pony knowing one strategy and one formula. I really want to understand Wall Street. And so thankfully, I had enough passive income and equity through my real estate to where I could make a pivot. And I left the oil and gas industry, and I worked for one of the largest brokerage houses in the United States. And I only spent like a year there. I got licensed and went through all the hoops and whatnot. And I wanted to learn stocks, bonds, mutual funds, and figure out maybe I was missing something. Maybe there was more to the story. And so after doing that a while and getting as much education as I could, long story short, I decided real estate was just simply better to me, in my opinion, for my own reasons. So I ended up leaving that world to go back into real estate, and I just kind of amplified it to a higher level with the syndications. Now, I'm not here to, bash stocks and bonds and whatnot. There's a time and place for almost anything that exists out there. I could make the case for or against a lot of different stuff, but things I didn't like about stock market, lots of hype, lots of volatility. I had invested in a few things that dropped, 40, 50% overnight. It takes a long time usually to recover from events like that. That was one thing. And then to your point about passive income, that's been my primary focus and strategy. Now, I don't consider a big major blue chip company that pays a 1, 2, 3% annual dividend to be a cash flow strategy, or to buy an index fund that gives you 1 or 1.5% dividend, or even a bond that maybe gives you 4 or even 5%. I don't consider these cash flow strategies. When I say cash flow in my own terms, I'm talking about 7, 8, 9, 10, 11, 12, 13. I've even got higher cash flow performing assets in my portfolio. So I've tried to take this point home. I've tried to basically average out about an 8% annualized cash flow return since 2015, when I really started to hone in on this concept. And I've actually been able to accomplish that. And it's not that every deal that I do has that high of a cash flow. It's an average. So a new deal would likely be lower in 2024, but I've also got deals that I've been in for 8 or 9 years that are cash flowing double digits, or I've got alternative assets or note lending that's doing 10 or 12% a year. And so it's all about living on passive income for me and teaching others how to do it. And so you could run some simple math and say, if you need $100,000 a year in passive income, well, if you took $1.25 million and invested that at 8% a year, that gives you $100,000 per year. And you can run your own math, based on different yields, but that's how I kind of reframed my thinking from the buy low, sell high, which is still a valid strategy. But I started really thinking about how do I create stable passive income for decades upon decades.
Yeah. And as you said, right, you take 2.58%, you get $100,000 cash flow per year. Not everyone has to start at that point. They can start at at 10,000, 25,000, 50,000, at
Yes.
whatever they want. It just, you have to start investing consistently,
Yes.
roll the profit back into the investments, and every year if you start investing uh 25K, 50K, 100K, whatever you can, right, at the end of the day, the compound effect that takes place, which you'll see after 10 years, you'll have a lot of cash flow on the hand per year.
There's a lot of parallels you could draw with investing, and it's no different from a psychological level than saying, I want to eat a healthier diet or I want to become a bodybuilder. If you're starting from scratch, that's a huge goal. To say I want to go from $0 to millionaire in 1 year. I mean, that it's unachievable. The same as I want to be a bodybuilder in 12 months and I've never worked out in my entire life. That's just too big of a goal. So to your point, you just start making consistent moves in the right direction, and everyone's time frame is going to be different. It took me nearly a decade, roughly, to cross a financial freedom threshold, but every market's different, every asset's different, everyone's goals are different. So it depends on how much work you want to put into it. I've heard of people doing it in as little as 3 or 4 years, and some people may take 20 years. So it's really up to you, and you can customize it. But to me, the goal isn't the financial freedom and say, okay, I made it, I'm there, I quit, I'm done, I'm going to sit on the couch, no more work. It's about designing an optimal lifestyle that fulfills you. Basically, the point is to generate happiness and fulfillment for you. So for some people, that's more stuff in their lives. I want new cars, new houses, bigger this, that, and the other. And for others, it's just the time freedom aspect. I want to be around my kids, my grandkids. I want to travel more. I want to do more charity work, volunteer at a church, whatever it is. We're all different. So I think that's really the goal, is to kind of get to know what really drives you, what really would be an optimal lifestyle for you, and use passive income to help get you there.
Yep. And as you said, right, it's about freedom of time, freedom, freedom of having time to do what you love, right?
Right.
Your hobbies, your passion, which you might not be able to give play with the kids, or take care, or explore some other business opportunity, right?
Yeah,
Which you are more
100%.
passionate about, which you cannot do when you're doing 9 to 5. Maybe you can do a side hustle, but can't focus 100% on a separate business opportunity. And and the other thing, maybe I would say, nothing wrong with 9 to 5, right? People love doing it also. Like there are many people who love what they're doing. They love the job. But the main focus is diversification, making sure that you have enough money when you need it, like during the retirement period, or if you lose a job at one point of time, you have enough income to sustain your lifestyle. So
Exactly. And so a couple of things. One, I want to start with a little case study to your point. So you said, for a lot of people, it may not mean quitting your job or quitting work. It just may be pivoting to something that better suits you. So if you take a case study, you look at some of the biggest names of investors in the world. We talk about Warren Buffett, or we talk about Carl Icahn, or George Soros, or Peter Lynch. These are guys who continue to work into their 80s and their 90s. They're going to work. They're waking up and getting dressed, putting on a suit and going to work because they want to, because they love the game. It's what they want to do. Obviously, they're all financially free and then some. They could have retired decades and decades ago. But for them, it's not the right fit for everyone, especially at an earlier age, to go into a retirement community and play golf for the rest of your life.
That's
Some
true.
people like writing and blogging and, podcasting and speaking and doing what they do, syndicating, whatever it may be. So it's really worth diving into, getting to know yourself and your values and kind of the top 10 things that really drive you. And this is the quote I like to share with people, something I made up years ago for myself. And passive income allows you to do more of the things that you love and enjoy and less of the things that you don't. So, maybe I don't enjoy mowing the yard, so I can use passive income and pay for a landscaping company to come mow my grass, right? And that frees up an hour or two where I can go play with my son and go take him to the park, and so it could be as simple as that. And a situation like that, we're only talking about maybe a couple $100 a month in passive income, and that could be achieved with $25,000 or something like that. So great points.
And if we can take a little step back, just on if you can give our listeners a little bit overview about your first passive income deal. How did you find that? And,
Sure. Do you want to take it from the syndication standpoint or just the first one ever in general?
first one ever in general.
So I bought this townhome in late 2009 in Fort Collins, Colorado, next to Colorado State University College. And I had just, come out of college. And so I knew, I was one of these people renting like this, right? Like not in the dorms, but kind of private, and my own stuff. So I thought, okay, I have to have a place to live anyway. Okay. So I can either rent or own. Real estate was on sale, much like it is right now in the commercial space today. And so I was able to get a 30+% discount on this townhome. Had an extra bedroom, wasn't married, didn't have pets and kids and things, no obligation. So what I did is the government had a tax credit for first-time home buyers. So I coupled that with a depressed real estate price. I went conventional with 20% down. I furnished this place with the tax credit that I received, and I rented out a bedroom that was fully furnished to a college student. And the end result was the amount that I got every month on the first paid for my mortgage, more or less. There was like a slight differential of about $50. So I figured out pretty early on in my early 20s, actually I was 20, how to essentially live for free, which cut one of our biggest expenses that we have as Americans. From there, I just started scaling the idea of living on passive income. How do I create more of these income streams where I can keep expanding my lifestyle? So the next rental I bought was a similar scenario, but I didn't live in it. And I rented that as a full-time townhouse rental. The cash flow from that allowed me to buy a car that I actually wanted versus the one I'd been driving forever that was a piece of crap. And then the one after that I bought, I had two more cash flow streams because I rented it to two different people at that point, two different occupants. So it was a little bit stronger cash flow. So, in a technical sense, back then I lived very frugally and very cheap because of my upbringing. I had about 4 or 5 passive income streams that actually paid for my entire lifestyle in my early 20s. Now, I wouldn't necessarily call that complete financial freedom because obviously I wanted to get married and have kids and have other things in life besides my current lifestyle. But it was a cool case study to go through, right? I proved it to myself that this is possible. And all I did from there, that was my foundational years. I just scaled it. That's it. Instead of having 4 income streams, I have 54 income streams today or whatever the number is, and that's the only difference. And so, you can keep rolling over the excess money into more and more deals, or you can spend it, you can do whatever, you can give it away. But that's the whole lifestyle design component and what passive income can do.
Right. And what about your first syndication deal? If you can talk about that.
that's a funny story. So I learned about syndication by getting out and going to real estate meetups because I just wanted to network with more people and learn what else exists besides single family stuff. So there was 2 guys that had put this group together who had sold their business in the mid 90s, and they had been full-time passive income investors for about 20 some years, whatever it was, long time.
Mm-hmm.
And I asked them, I said, they invest in a lot of stuff. And I said, what's your number one investment? Like if you could only invest in one thing for the rest of your life, or the best one you've had so far, what is it? They said it was value add multifamily commercial real estate. They said, we do private placement investing. We're limited partners. I had no idea what any of this stuff meant. I didn't know it was something I could do. I thought maybe these guys are, billionaires or something. This is in a whole nother level than what I'm in.
Yeah.
But it turns out, they were very, very transparent and open, and they shared with me going through 2008 and 9 and 10 and kind of just how well this asset class has held up for them, and the stability and the everything that you mentioned earlier, the tax benefits, which I'd never put much emphasis on before. And I always joke, I never got into real estate for the tax benefits, but I stay in real estate for the tax benefits. And that's kind of the conclusion a lot of us come to. But anyway, they introduced me to a local group, and I was selling a flip, and I was very skeptical still at this point. I'd never done a deal like this. And I thought, what I'm looking at on a pro forma is basically suggesting I could make the same kinds of returns that I'm making actively without having to do the work. I didn't believe it. So I said, okay, but I did want to try it. So I said, okay, I'm going to take half of my equity that I'm making on this flip, and I'm going to put it in a syndication. It was probably 25,000. It was like a really, really low amount. And I waited about 6 months, and I wanted to make sure I was going to receive the cash flow as, outlined in the pro forma, and that the business plan was really going to be happening in real life, not in theory. So it was a local deal that I could go visit. And I fell in love with the model, is the long story short. I ended up doing another deal with that syndicator, and then I ended up finding more syndicators and doing deals with them. And that led me to doing deals with Ashcroft. And, I've done deals with a lot of different operators in the space. And it's just one of those things. I think sometimes you just need to take action, even if it's a small, measurable step, and just try it. We can sit here all day and debate over, theory and whether something's going to work or not. But sometimes just stepping in the game, putting some skin in the game makes all the difference. And that was true in my case, at least.
Rightly said, right? You got to take action at the end of the day. You can read at any time, you can read like numerous books, attend number of meetings, listen to podcasts. But what good it is if you cannot implement the strategies that has been explained in there. Exactly.
So one quick story on that that's kind of funny. In 2000, I forget what year this was, 14 or something, I made a goal. I said, I'm going to read one book a week. So that's 52 books for the year. And I did it. And I found that to be a huge mistake, because in the meantime, I almost took no action. I was just busy reading all the time, and my head got so filled up with so much content that I got stuck in analysis paralysis, because this book said do that, and this book said do that, and should I do this or should I do that? And it was like drinking from a fire hose. And so the right approach for me anyway is to read maybe one book, maybe two, and then go take action. Go try it out. See if you like it. If you do or don't, depends on what direction you take from there.
Absolutely. Right. So what is the advice that you like to give to investor who wants to jump into passive investment? How should they start? How should they find the right operators, or, filter them, screen them before they invest with them?
Well, I spoke a little bit about kind of knowing yourself and what drives you and what fulfills you. I always start with my own goals, and I try to kind of reverse engineer. Okay. So if I say, okay, in 10 years, this is kind of where I want to be at, and kind of the lifestyle I'd like to have. I try to envision that. I try to write that down. I try to really, I've even done like, picture storyboarding, vision boarding, whatever they call it, and then I work backwards. I think, okay, how much is that lifestyle going to cost? What's my income going to need to be, and then what kinds of investments could get me there in that kind of time frame. So if we let's just use an example of a value add multifamily syndication, okay, because I do a lot of those. So typically the hold period on those is about 5 years, okay? Ideally you sell early, but it depends on the market and all that kind of stuff. So let's just say, I don't know, say you could, I'm just using a simple arbitrary example purposes thing here, but if you could double your money in 5 years, let's just say, and you could do that twice in a 10-year period. So, you take your 100,000, it becomes 200, then the 200 becomes 400. I'm not including taxes and stuff like that. Well, now you have a lot more leverage at that 10-year point to go put $400,000 to work at 8% instead of sitting on a deal with your original 100,000 investment and never selling it, where the cash flow goes up a little every single year, but you're not really leveraging the velocity of capital, putting money into something, growing it, extracting it back out, putting it into something new, and rinse and repeat. I love that business plan. Every single deal I've done, with the exception of one, has been the velocity of capital. Buy something older and pre-existing, fix it up, make it nicer, newer, worth more, sell it, either 1031 exchange or cash out, whatever, and then roll it into more and more deals. So start with your goals as number one. Find investments that make sense to help you accomplish your goals. Some people like, development deals and equity deals and buy low, sell high deals. They're trying to build up a nest egg and build up net worth. And that's totally cool. That's one goal set, of an investor. Other people are saying, hey, I'm about to turn 70. I'm retired. I need cash flow. And they're more interested in maybe note lending or something that gives them a 10% annualized yield and pays out on a monthly basis. They're more interested in living on cash flow right now and not waiting 5 or 10 years for future results. So you just have to know you and what your goals are. And then you got to find who's doing these types of investments. Stock world's pretty simple. I mean, open up a brokerage account and get your financial advisor, do whatever. And private equity and real estate, I just started networking. You can go to platforms like BiggerPockets and LinkedIn. There's tons of forums out there. They keep expanding every year with more and more, places, crowdfunding sites. And you can just find different operators and different deals and different sponsors. And now there's even more review sites coming out. And so you find groups that you get along with, that have good track records, that are doing what you like, that you understand, and then partner up with them, is kind of a simple way to look at the 3-step process to getting started. Hopefully it's not too much information for your listeners, but you can always leverage people like myself or anybody else in the industry that's doing what you want to do, and then just kind of pick their brain, right? I open up phone calls for people all week long, all year long for 15 minutes. I'll talk to anybody about anything. So, if you want to know about some sponsors or past experience or websites to visit or review sites, I'm happy to point you in the right direction.
That's great, Travis. So with regards to the current market condition, maybe we'll switch the gears, move on to the current market conditions of the real estate investments. So what do you think the biggest, or maybe do you see any risk as of now in multifamily investments, given, the interest rate going up, many of the loans, the insurance getting expired? Do you think there is going to be a downward trend on the overall pricing for the multifamily? Do you see that risk or no?
Yeah, so every quarter I create a market insights report with Ashcroft Capital. And what I do is I pull data from all the reputable national sources. We're talking about CBRE and Marcus and Millichap and Urban Land Institute and the US Census Bureau and all these different things. And I put together basically a 15 to 20 page downloadable PDF. This is free for anyone. It's on ashcroftcapital.com. And I'm going to kind of use that as a frame of reference for answering your question. So after evaluating that data, and right now I'm actually going through the current data because we're about to close the quarter, right? I'd say we are very close to the bottom if we haven't bottomed yet in the cycle of commercial real estate. Now, something to keep in mind is you got to put the big headlines to the side because a lot of them don't even make sense. When you read a headline that says something like, commercial real estate is in distress and it's falling apart and the sky is falling, you have to read between the lines what they're talking about. Okay, office is one sector, okay? And new office buildings in prime locations are another caveat to that. And old office buildings in suburban areas where there's no population are another scenario, right? And then you've got hospitality, and then you've got multifamily, and then you've got self-storage. So we have to know what specifically we're talking about. Multifamily, which is mostly what I invest in, has very strong fundamentals. Nothing has really changed on the fundamentals of multifamily. What we're facing as a challenge is a capital market challenge, which is the people who got a 3% loan and are now having to refinance at a 7% loan. That's everything to do with debt and very little to do with the property itself and who's renting there and who's paying and what your collections are and your cash flow and stuff like that. The other issue that we're having in certain markets, again, it depends on the market, is a supply issue this year because the market started to skyrocket in 2021, talking about real estate, stocks, crypto. People were throwing money at everything. It got very overhyped. Now it's settling back down and returning to normal. And developers started to jump in 2021 because they wanted a piece of the action. Well, it takes a few years to build and bring product to the market. And so now some of those deals are coming to market, and that's going to create a lot more supply and competition in the short run. But then on the flip side, developers have been pulling out since interest rates started coming up. And so if you think longer term, like 3 to 5 years, we're going to be back to a supply-demand imbalance, which is a good thing if you're getting into new deals this year. So I'm a little more bullish this year, actually a lot more bullish this year than I've been in many previous years, because I knew we'd had a great run. I've been part of that run since 2009, and I knew, the markets, they go in cycles, and it's inevitable. There's going to be a cycle. So we finally hit it, which is not good news for the existing properties in the short run, but it is good news if you can buy a property today at a 25% discount and it cash flows with a high interest rate, and then the Fed comes in and they cut rates, let's say, in the next 2 or 3 years. This is a fantastic scenario if you're just getting into these types of deals. Whether it's development, again, which will take several years to come to market, or it's a value add deal that you're buying at a discount. I think 24 is a great year. I'm super excited for it.
Yeah, you rightly said, right? If the deal pencils out, if there's a cash flow, it's, you can always refinance the property once the Fed brings down the rate. And that will just increase your, NOI and the value of the properties drastically.
Exactly. I mean, the simple way, if someone's listening right now that's new to this concept, very, very simple. It's just like with bonds. So when interest rates come up, then valuations come down on commercial real estate. Okay. But right now we're at the top of this rate hike cycle. So what happens when they come down? The valuations come up. So it's better in many ways than when I even started investing from 2015 to say 2021, because rates were just kind of like 3 and 4% up and down year over year. Well, now you might be going from a 7% loan down to like a 4.5 or 5% loan. That could really help out the performance, either by cash flow or valuation or both, or refinance situation. So fantastic, unique opportunity right now.
Yep, absolutely. And any other key considerations that passive investors need to look into with regards to the operator side,
Yeah, there certainly are. And I mean, truthfully, Ted, we could talk for probably another hour on just that topic alone. So what I'll say is this: I'm concluding literally this month, in April, next month, my podcast series. I've ran 2 over the years under the best ever real estate investing advice with Joe Fairless. It's called Passive Investor Tips. And what I've done is I've taken 100 episodes that are 5 to 7 minutes in length. These are not guest hosted spots. This is just me articulating concepts and formulas and tips and tricks and strategies on the mindset, the philosophy, and how to become a full-time passive investor. I would check that out because I address all of this in a lot greater detail: how to vet deals, how to vet markets, how to vet sponsors. And if you ever can't find an episode, reach out to me, Travis at ashcroftcapital.com, and I'll send you every resource that I have on that topic to help you out.
Awesome. All right. Travis, just wanted to be considerate of your time. Would like to move to the final round of questions. Are you ready?
Yeah, let's do it.
All right. So the first one, which is the one book that you'll recommend that had the most impact on your life or on your business?
So years ago, I read a book. It was called Tax-Free Wealth by Tom Wheelwright. And it really opens your mind to how many different ways you can generate income and paying little to no tax on it. And I didn't realize how all of the depreciation worked and the cost segregation and the bonus depreciation, all the stuff in real estate until years and years later. But it's a pretty amazing thing if you think about, truthfully, one of our biggest expenses in life is going to be paying taxes. So if you can learn by the help of a licensed CPA and your own research how to bring that down either to zero or at least down significantly to maybe 5 or 10%, that compounding effect is huge. I mean, the amount I save every year in taxes just allows me to do more investment deals that I otherwise wouldn't have been able to do. So it's like having a free investment. I look at it as almost having like a risk-free investment, because if it goes bad, it was really just tax savings that allowed me to get it in the first place. So that's a great book to check out.
Awesome. And what are your main source of information to learn and grow?
I was studying, and I'm not plugging this just because I'm part of Best Ever, but I was studying the Best Ever CRE.com, which stands for Commercial Real Estate, before I ever came on board. What they do is it's a commercial real estate educational platform, and it's free for people. And so every single day there's blogs, there's content, there's videos, there's podcasts, there's interviews, there's downloadable white papers, there's calculators. BestEverCRE.com is just a great place to keep up with current events and trends and different asset classes and pros and cons and, conferences and events and stuff like that. So I recommend that as kind of a catch-all place to go.
Awesome. All right. What is the best business or investment advice you'd like to give to our listeners?
I would say double down on what's working was advice given to me by one of my mentors early on. And it came at a point in my life where I had been trying a lot of different things that weren't working. And the only thing that was working was real estate for me at that time. And so it was basically to kind of wake me up to hyper focus and again, just double down on actual results. I tried clothing lines and selling, e-commerce stuff and all these different things, and all these businesses were failing. And so I'm so glad I took that advice because, there's only so many hats that we can all wear. It's hard to go run 5 or 6 different businesses. So just focus on, what's most profitable and figure out how to be the best you can at that.
That's a great advice. All right, Travis, last question. How can Decoding Cashflow listeners get in touch with you?
Yeah, a few different ways. I'm on social media. So I've got a YouTube channel, Instagram, Facebook. The handle is @PassiveInvestorTips, or you can find me on BiggerPockets and LinkedIn or AshcroftCapital.com. You can find me there as well. And always happy to be a mentor or resource. I put my calendar link on all of those different outlets. So be happy to connect with you for 15 minutes or longer if needed, and just point you in the right direction and add as much value as I can.
That's great. Thanks a lot, Travis. It was a pleasure to meet you, and great having you on the show.
Same here, Ted. Thank you. Thanks everyone for listening.
Thank you. Thank you.
Thanks for listening to Decoding Cashflow, brought to you by Ashcroft Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astorcapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.